Hi, everyone. So today I'm with Dom, and we are going to be covering Berkshire Hathaway, specifically Berkshire B shares for Q1 of 2026. Dom, whenever you're ready.
All right, let me know you can see my screen.
Yeah, perfect.
Awesome. So today's article won't be as long as we typically have, but it does hit the key metrics that we're looking for the company. So we'll just kind of jump right into it. So it says here that Saturday's reported numbers were at 11.35 billion in operating earnings and a record cash pile. And the first quarter under CEO Greg Abel, the successor to famed investor Warren Buffett. It says that Berkshire Hathaway's massive cash pile rose to more than 397 billion in the first quarter, which is up from 373 billion at the end of 2025. Operating earnings were up nearly 18% from the last year, but fell short of estimates that Berkshire would earn 11.56 billion, according to FactSet data. Then they say net income attributable to Berkshire shareholders in the first quarter rose to roughly 10.1 billion, more than double from 4.6 billion in the last year. Berkshire earned 1.7 billion from insurance underwriting, a 28% increase from the same time last year through Geico, which leads the conglomerate insurance writing. Excuse me, which leads the conglomerate's insurance underwriting business reported a 30% drop in earnings. So that's really the most important part of the article right there. It's interesting because they made billions of dollars more than the year prior, but they were still missing on some estimates depending on the metric, which I think is so fascinating because we're talking about billions of dollars here. So in terms of like the actual quarter, they missed on a couple of the bigger ones, but they've made so much money that like it just seems kind of silly. But it's kind of like a mixed report, unfortunately for them, because since they weren't hitting the metrics that were expected. But yeah, that's kind of how their quarter looked for them under their new leader with Warren Buffett departing. But I wouldn't say it was too bad. wasn't as bad as we've seen in previous videos from other companies, but didn't hit all the marks. So we'll switch over to Matt, and we'll kind of take a look at their financials and see how they're doing.
All right, great. Thanks, Dom. Appreciate it.
Yeah.
All right, so we're going to first kind of more or less give this a good analysis, Dom and I, because the interesting part is about Berkshire is that how they're valued is a little bit traditionally different from our other videos. So, for example, Buffett himself says not to include as a valuation their net income and their free cash flow future projection because it's very hard to predict that. You have insurance, like Dom was saying in Geico, with underwriting swinging wildly with the market, also with their portfolio as well. You have Apple and Coca Cola, unrealized gains and losses like well, every day, everyone knows how volatile the market is. So you have to be very careful on how you use these metrics because they really don't apply to Berkshire. It's too different of a company because they're really their main factions are their investment portfolio and their actual business, wholly owned businesses that they like Geico, BNSF, which is the railroad, amongst other companies, more famously within the portfolio that they actually own themselves. So keep that in mind when you're looking at it and when we're doing this analysis on the whole company altogether. Now, that being said, the most important ones are operating earnings, like Dom said. Free cash flow, multi-year growth, it's still important, but you're just looking for consistency and balance sheet strength, which we're going to cover as well. Now, the next thing we're going to take a look at is Berkshire B stock, like where it's currently trading at. It's currently at 465.52. It has been selling off a smidge from their 52-week high because of the earnings. So we have 52-week high of 521, a 52-week low of 455. So it's certainly within that nice 52-week low area that we all love. Remember, keep in mind, this company's $1 trillion. So it's massive. You don't have to feel threatened and it's not too volatile either. Yeah, just keep that in mind. It's not like even if it had a down day, it's only 0.63%. Like that's nothing. That's like zero volatility. It's known to not be volatile. Uh, the next thing we're going to take a look at is Simply Wall Street. And Simply Wall Street, again, this is balance sheet. This is not free cash flow generally. So this is just cash and cash equivalents and equity. And as you could see here, for the balance sheet, it looks very good. I mean, it actually looks incredible. Like, I mean, even from 20, what is it, 15, you have 64 billion. Now it is at 397 billion. I think it's actually more. I think it's above 400 billion, but just for sake of argument, 397.38 billion. I mean, that is insane how much cash they have. That is cash on hand. And that's, I think, the big metric that's marketing out online all over the place. And you could see that their debt is pretty relatively stable. Same with their equity. So they're in terms of balance sheet, debt to equity history analysis, or just balance sheet analysis, it looks incredible. It looks safe, like this is a safe haven stock. The next thing we're going to take a look at is my DCF. And again, we can't use alpha spread. Those operating models, those metrics don't traditionally work. So I'm going to break this down for everyone. For the DCF model, I just put in Claude. DCF model for Berkshire Hathaway B, 3% terminal growth, like I usually do, 9% interest rate, and 5-year forecast. And they built me a model, surprisingly. And it came out for a base case. This is just normal case based on shares. That it comes out to $480 to $520 a share. Me personally, and Tipranks is gonna more or less agree with me. I do think that Berkshire is really a $520 share stock. Just the way I see that cash is at an all-time high. Operating earnings, they weren't great this quarter, but I think they're going to eventually recover. Insurance in general is not at the height, and it's a cyclical market, so you have to keep that in mind. So all these things factor in, but I still think they're going to do well, and I think Greg Abel is really going to do well as too. A thing we didn't mention is share buybacks. They are starting them again under Abel with their free cash flow. So keep that in mind when you're thinking about the valuation too. And just to take a look, the growth, it does look good. A modest recovery 2025, a dip as BNSF, that's a railroad, MSR normalized. You have free cash flow conversion. So, I mean, these things are more or less going to recover from 2025 going to 2026 and then the future 5 years. I think it's going to be perfectly fine. I think it's going to be still a great business that makes a lot of money, and Abel's going to be able to invest in more businesses and buy them out. And lastly, we have Tipranks. And Tipranks this is also going to look weird for people too, because normally we see a million analysts saying, "Oh, it's a moderate buy, this and that." They don't really do that in Berkshire. They don't have analyst coverage that much because they don't allow them to really do that. They don't pay analysts. They don't do any of that kind of game. They only think long term, but they only have one analyst that covers them. It's a moderate buy for them. It's one buy, 22% upside, and the upside is $570 a share on average. So, excuse me, two buys. Sorry, it only says one buy, but it's actually two buys. And we have both 5-star analysts that both think that Berkshire has more or less so of some kind of bullishness to it. This is old. This is from 2025, so you can't go by this guy that he thinks is 481. That's irrelevant information because Q1 came out, so he has to do an update. I don't know when he's going to do it. And this is more recent. This is from May 4th, and he still thinks it's going to be 22% upside. And he revised it down slightly. But still, regardless, it's trading at 52-week lows, so I still think it looks pretty good. Dom, is there anything else you would like to add?
No, I think you did a great job, especially explaining how their metrics work different than typical stocks that we review. But yeah, I think they actually look really good as well, and definitely worth something to keep on the watch list.
Yeah, totally agree. All right. Thank you, Dom. Thank you, everyone.
Thank you.